Good morning, everybody, and welcome. I see there's still a few guys coming on, but it's 9 o'clock, so let's get going. So we've got the Prescient China team with us this morning. I think China has been a hotly debated topic in the Western press and by fund managers, ranging from those who believe it's fundamentally uninvestable to those who are emphatically bullish about it. And I think we're very privileged to have the insights of the Prescient China team, who actually resides in Shanghai and live and breathe that economy on a day-to-day basis, to give us some real insights on the lay of the land. So I'm going to hand over to Tawanda, who's going to introduce our team there. Thanks, team, man.
Super. Thank you, Adrian, and good morning, everyone. It's a pleasure to welcome one of the managers, or to host one of the managers that we make use of. Like Adrian had said, today we're going to go global. Our focus really is on the Seed Global Fund, which makes use of Chinese assets. As you know, the Seed Global Fund is the winner of the Citywire Best Fund Group in USD mixed assets, and that was in 2022. The following year, it was nominated again as one of the top funds in that category. So that long-term performance for that Seed Global Fund has really been great. And one of the strategies that has been a differentiator over time in terms of our offshore investing is the Chinese exposure. Next month, Seed will actually reach a 10-year milestone in terms of our investment in China. So yeah, as of October, then we would have had 10 years investing in China. This has obviously been beneficial over the long term, and so we thought it would be appropriate to touch on China. As Adrian has said, China has been quite topical. Whilst the long term looks very good, or the long term performance has been really good and added value, the short term history hasn't necessarily been the best. We've had some pain points in the recent short term history. And dependent on who you listen to, whether it's on the western side or the eastern side, what you hear on China can be very, very divergent. Given China's short-term underperformance, I suppose if there's any grief related to the Seed Global short-term performance, then I suppose I have the right person for you to direct it at, and that person is not me. With that, I have to say that we have the pleasure of welcoming Tian. Tian is the head of China strategy and product at Prescient. Tian holds a Bachelor of Business Science honors degree in Actuarial and Quantitative Science from the University of Cape Town, and is a fellow of the Institute of Actuaries and a Chartered Enterprise Risk Actuary. Tian is responsible for China's overall product offering and the investment strategy. He's a member of the Prescient China Investment Research Committee and specializes in research of the Chinese economy, and also being their in-house expert when it comes to global geopolitics. Like Adrian said, Tian and the team are based in Shanghai, China, so we're in very good hands for a first-hand, on-the-ground perspective. So without further ado, I'm going to hand over to you, Tian. Tian, good morning. I suppose you can share your slides and then go through your presentation.
Good morning, everyone. Thank you, Tawanda, for that kind introduction. I am joining everyone this morning from sort of cloudy Shanghai. We just had a typhoon rip through the city 2 days ago. I'm glad our office building is still standing. It was apparently the strongest typhoon since 1949, actually since the founding of Communist China, as we know it today. But today I'll aim to update everyone on what's happening lately in China, and why China is nowhere near its communist state that was founded back in 1949. I'm going to run through a quick presentation, and as Tawanda and Arya mentioned, I think there'll be a lot of topical issues, and I'll be glad to take any questions, especially on geopolitics as we run up to the US elections, and a lot of actually market movements driven by a lot of political factors these days. So with that, I'm going to jump straight into the presentation. Firstly, I think an update on just basic economic numbers and overall Chinese economic policy. So everything on the slides are pretty much color-coded. Green is fairly positive. Red is slightly negative. We actually don't have terrible data coming out of China. CPI is actually done a bit better than the previous 2 months. We were 0.2% in June, 0.5% in July, and in August we are at 0.6%. We are looking for that CPI number to get higher towards the 1 to 2% range. And we are heading there. PPI going in the opposite direction. PPI and CPI in China not necessarily always. They actually always move, not really in sync with one another. But PPI's number worsening in August relative to July, a drop of 1.8% relative to July's decline of 0.8%. Retail sales, a number that many economists have been focusing on because it's consumption related in China, actually doing quite well in July. The latest numbers we have from July, accelerating from June's 2% to July's 2.7%. Exports is kind of the shining star out of the Chinese economic numbers. For the month of August, it was up 8.7%, way above expectations. Consensus expectations were 6.5%, so we were more than 2 percentage points above expectations. And then lastly, sort of a bad number, but something that's been with us for 3 to 4 years now, is a continued deterioration in housing prices. So housing prices declining 4.9% year on year in July, relative to the 4.5% in June. But that's sort of already been probably more than priced into the markets. For housing numbers, we don't expect any improvements in the numbers coming through probably for the next 3 to 5 years. So that's something that's been written off in our mind, if I can call it, for the foreseeable future in the Chinese economy. But that's something that's going to be a drag, but not a deal breaker for Chinese economic growth. Moving on, PMI numbers have often been a focus of the Chinese economy. Financial media outlets typically try and relate or attribute daily market performance to PMI number movements. We do watch PMI closely, but we think it's often overblown in terms of financial media outlets saying it's the so-called or main contributor to market volatility. If we look at the two charts on this slide, the blue line is the Taixing Chinese services and manufacturing PMIs. They more relate to the private sector. They are more heavily weighted to the private sector, and the red line is more weighted towards the state-owned sector. So it's actually very encouraging to see the private sector consistently being more confident than the state-owned sector on average. If we look at the services PMI, both numbers are above 50 in expansion territory, and the manufacturing PMI, sort of private sector in expansion, and state sector slightly below 50, so in slight contraction territory. If we look at a breakdown, overall the negatives are employment continued to contract in August, but external demand increased with increased foreign visitors coming to China. China recently applied a lot of unilateral visa-free or visa waiver policies towards European countries and some select countries in Africa and Australia, New Zealand, etc. So that's showing some fruit on the manufacturing side. We're seeing production of consumer and intermediary goods outperform investment products, which is also positive. It's more related on more confidence on the consumption side. So data all heading in the right direction. If we look at Chinese PMI numbers relative to its peers, services, the PMI numbers are okay-ish because we're above 50, we're expanding, but we are behind peers on average, so behind US, Germany, Japan, and India. But where China is really doing well is on the manufacturing side. So the 49.1 number is often used as a scapegoat for poor market performance in China. But if you look at how China is performing relative to its peers, it's actually doing great. India, obviously, the outlier compared to every other country recently. India is just really, really hot, and it is the place to be. But we are slightly, or actually quite worried about India in terms of valuation, which I'll talk to a little bit later in the presentation. Another data point, what we've seen recently is a very sharp correction in the Chinese yuan. So the Chinese currency strengthening significantly from about the 7.3 mark to under 7.1. So it's sort of a 2.5% strengthening in a very short period of time. And we expect further strength in the CNY, which will also come through in the rand and dollar returns of your investments in China as the currency strength comes through, because everything we invest in is denominated underlying in CNY. Right now, what we are seeing in the local Chinese markets is general loss aversion in the equity markets. As Tawanda mentioned earlier, the Chinese equity markets haven't done well. But this chart, this is a Bloomberg screenshot of how Chinese 10-year government bond yields have compressed, which means bonds have rallied over the past few years when equity markets have declined. And as equity markets continue to underperform, we've seen massive funds being plowed into bond funds in China. That's why the Chinese government bond yields continue to decline. This is just showing what's happening in the markets lately. What we are seeing in the equity markets in China, so what we saw in sort of March to May, average daily trading volumes in Chinese equities about CNY 1.1 trillion. So that's about 2.7 trillion rands of daily trading volume equivalent. What we are seeing now in August, September is that daily trading volumes have halved. So there's less participation in the Chinese equity markets currently. So sentiment right now, as we stand, is pretty low. But you can see from this chart that these sort of sentiment swings are very volatile. So it can change very quickly in the Chinese market. And we believe it's probably a good opportunity right now to wait for the rebound. In terms of policy direction, we are seeing quite a lot of good support from the government. What we've seen recently, so just in August, the past month, we've seen an additional 1.4 trillion CNY of loan commitments for the real estate sector, again, to help stabilize the real estate declines, almost $200 billion. This, by the way, is in addition, since October last year, in addition to already around 4 trillion. So this takes us to almost 5.5 trillion CNY of total debt and loan support for the sector. That's why we do not expect a collapse of the property sector. We expect it to be a drag on the economy, as I mentioned earlier. But we're going to be very far from overall the collapse theory that we're seeing from a lot of sensational media outlets. In terms of policies, further policies for the housing sector, a housing pension system is being launched. So that's not necessarily to support the property sector itself, but is more, if anyone's been to China, one would have seen that property maintenance is not really a focus of the industry. People typically just buy new, wait for it to get old, sell, and then buy new again. So that's looking to change. Policy is looking to change that. And that's largely to support all of the construction, sort of home appliances, all the related sectors to the property industry. So with the property downturn, not only is the property sector struggling, all other related industry have been affected. So all of these policies are to support related industries, which we again see as quite a strong positive. We are seeing property purchase restrictions being lifted in cities even like Shanghai. So even though overall housing prices across China have declined, cities like Shanghai, due to its prime location, due to its extremely limited supply, pricings in Shanghai has actually increased, funnily enough. So also, depending on where you look in China, property is not all bad. So in Shanghai, for example, it remains strong, but purchasing restrictions have been lifted to try and support the overall property sector. So we do not expect large fiscal stimulus to bail out the sector entirely, but we continue to expect supportive policies to ensure an orderly decline or normalization of the Chinese property sector. If we look at other non-property related policies, it's very clear that the Chinese policymakers are trying to aim to drive for consumption. That's essentially what drives the services sector. That drives more than half of China's GDP. And so we saw in July, a couple of months ago, the Chinese central bank PBOC cut both the 7-day and 1-year medium-term loan funding rates. The 1-year rate is the most significant. 20 basis points is probably it's very, very high compared to historical trends. So it's 2 notches. Typically, Chinese central bank cuts in steps of 8 to 10 basis points. So we saw a 20 basis point once-off cut, and it was a move ahead of the Fed rate cut. So it shows policymakers are quite understands the urgency of the issue. We expect further cuts in reserve ratio requirements this month or next month. It's going to come through soon. We saw governors in the central bank hinting towards that. And we've seen states of consumption vouchers being released in Tier 1 cities. Tier 1 cities are typical where the government has more budget to play around with. So in Shanghai, for example, last week we were notified every single person here would be given a CNY 2,000 or up to CNY 2,000 or equivalent to 5,000 Rand consumption voucher if we bought anything home appliance or computer related. So this is the biggest we have seen in China history. So we expect consumption to be driven at least somewhat by these consumption vouchers. So these are very positive things, policies coming through. Previously, we only saw quantums of 100 CNY, 200 CNY vouchers. This time it's almost tenfold of the biggest we have seen previously. So all the policy coming through in the right direction. So we're quite confident that the policymakers know what they are doing and we're heading in the right direction. So that's a quick update on what's happening in China last few months, or at least this year. I want to take us back a little bit to revisit the question of why one should invest in China. And we get back to some of the very basics. So firstly, China, I've got sort of probably not the most accurate title, but it's there for a reason. So China's got the largest GDP in the world now. And many people don't notice that, as that if you adjust for purchasing power parity, China overtook the United States in the last couple of years. But this slide aims to put China's economy into visual perspective. So if everyone focus on the bottom left-hand side of the slide, this is South Africa. South Africa's annual GDP at about $370 billion. This is the United Kingdom at around $3.5 trillion annual GDP. India, sort of the star of the moment, at around 3.9 trillion, so a bit bigger than the UK. If we look at China's nominal, China mainland, that excludes Hong Kong and Taiwan, just the mainland, is $18.5 trillion. So just by scale, and we've done these circles somewhat to proportion, it just shows you how big the Chinese economy is. Obviously, the USA, the largest economy in the world by nominal means, at 28.8 trillion is the largest. But if we look at China based on purchasing power parity, it's at $35.3 trillion. It's just so big that we believe one definitely needs some sort of exposure directly to mainland China. It shouldn't be a small allocation as part of an emerging market allocation. So it's allocation of an allocation. So to give everyone an idea, on a nominal basis, every year, if China grows at 5%, for the next decade, it's growing almost $1 trillion every single year. So that's 3 times South Africa. Every year is just China's GDP growth. So it gives you a scale, gives one an idea of the scale of China's economy. The next slide we want to show, we've seen a lot of sort of noise to say, oh, there's a lot of onshoring, the US suppliers, for example, Apple moving its factory to India, to Vietnam, a lot of the clothing manufacturing moving to Southeast Asia, to Bangladesh, to Vietnam, etc. But in reality, China is just irreplaceable. If we look at global manufacturing GDP, China represents almost 30% of global manufacturing GDP, or everything manufactured globally. US comes in next at 15%. Then we have Germany. Then we have Japan, or 2 other major exporters globally. And we have India at 3% and the rest of the world. So you'll quickly notice countries like Vietnam, Bangladesh, Mexico, they don't even make the chart in terms of single-digit numbers. So if we look at China's 29%, it's actually more than US, Germany, Japan, and India combined. So it's really quite far-fetched to say China is going to get replaced as the world's factory. it is by far sort of the country with the biggest sort of advantage of economies of scale. It's able to produce everything at scale at the best prices for certain quality. So we do not believe China is going to get replaced anytime soon, or probably ever, at least in our lifetimes, as the world's factory. So these are two economic data points to sort of show everyone why we believe China should be not just the irreplaceable factory of the world, but an irreplaceable part of your global portfolio. If we look at from a financial perspective, we believe, or not we believe, the data shows that for South African investors, China onshore, the yellow bar, is by far the best diversifier for South African investors. So South African investors with Reg 28 have the majority of their assets in South African equities, and Chinese onshore equities by far have the lowest correlation to JSE All Share. This data point actually applies to global equities as well. So Chinese equities have some of the lowest correlations to the S&P 500 too. Interestingly, if we look at the chart on the left-hand side, the MSCI emerging markets have on latest long-term correlation numbers almost a 90% correlation to the JSE All Share. So you're actually not getting much diversification benefit by simply allocating to MSCI emerging markets. If we look on the right-hand side here, the purple bar is MSCI China, which a lot of people believe it's an easy access into China, but MSCI China is very concentrated in purely tech, Chinese tech, property, and finance. That's pretty much the makeup of the index, which is why it's actually higher. It's more correlated to global equities. So that's why we continue to emphasize the importance of Chinese onshore equities in the form of CSI 300 to help diversify for South African investors. And what does this diversification mean? We always talk about diversification, and we use one very, very recent example. So if we look at from Friday, 2nd of August, and Monday, so it's over 2 trading days, many people would have forgotten is that both Japan and South Korea crashed double digits over 2 days, over a period of 2 trading days, whereas China actually was pretty flat. China onshore, the blue line right at the top. China was down 1%, just under 1% over those 2 days. The Nikkei was down 13% in dollar terms. The Kospi, the Korean benchmark, was down 12.6%. So in times of extreme volatility, it is more likely for China onshore to be unaffected by the volatility than it is for any other part of emerging markets, for example. We have another few lines. We have the S&P, NASDAQ, and the Hang Seng. The Hang Seng is the part of China that's more correlated with offshore equities. So these are sort of 4 main points why we believe investment in China, especially China onshore, is quite important, and that's where the Seed Global Fund is majority invested with us. So with that, I'm going to move on to Prescient's performance and positioning in terms of our Prescient China Balance Fund. Our Prescient China Balance Fund is really your all-in-one product. So all-in-one China solution product. So we have China onshore equities, we have Hong Kong equities, and we have China fixed income. Where we are currently in September is that we are about 65% equity downside exposure. We have about 20% protected equities. The protected equities is largely the Hong Kong portion, which is more volatile, but we spend some money on protection. Right now, we have about 15% fixed income, largely cash exposure as at early September 2024. Compared to our position in May, where the market was rallying, we were up to 97% equities. So we've changed. We allocate our asset allocation very, very actively. So we have a daily dynamic asset allocation process that we follow, and we manage the overall China allocation within the fund. In terms of performance, this long-term performance number, over the long term, we've significantly outperformed our sort of reference benchmark, 65.35, and our CPI benchmark. But I think the more interesting chart is this year. So if we look at the red line is the Chinese CSI 300 total return index. The red line represents pure equity index, and it's been mixed this year. But as at the end of August, the equity markets were slightly below, so underwater. It's lost money for the year, whereas our Prescient China Balance Fund, which is the dotted line, quite significantly outperformed. So typically what we try and mimic in the Prescient China Balance Fund is on market up rallies, we try and keep up with the market. And when the market drops, we try and, on average, achieve about 65% of market downside, but 100% of market upside. So this year we've done fairly well, given the tough market conditions, to still outperform the market. Over the long term, I think Tawana mentioned we're coming up to 10 years since Seed invested in this fund, in our fund, and I'm quite pleased to show a very positive long-term experience. So you can see this is the blue line, the blue dotted line is the Prescient China Balance Fund. Everything is net of fees, by the way. So it's been volatile, but over the long-term performance has been strong. This green line is the MSCI China Total Returns Index. You can see our fund comfortably outperformed over all periods. MSCI China Index, we comfortably outperform our onshore benchmark, the CSI 300 Pure Equity Index, and this red line, the MSCI Emerging Market Index. So over almost a decade, so over, in the next couple of weeks, it's going to be 10 years, so these numbers won't change too much. Net of fees, we have outperformed cumulatively MSCI China Total Return by 74% over almost 10 years, outperformed CSI 300 by around 45%, and outperformed MSCI Emerging Markets by around 46% cumulatively net of fees. So even though Tawana mentioned the last few years have really been tough in China, we believe, we've always said, it's for a market as volatile as China, is very, very important to have a strong active manager, and we believe we are that manager. So it really helps to improve your overall China experience. So our volatility on average is much lower than equity markets, and overall the return experience also is better. So with that, I'm going to conclude. I think right now, Chinese economy is solid, as I shared in the first part of my presentation. The positive is that the economy is recovering post-COVID and post-COVID consumption slump, but the negative side is that because the economy is actually quite okay, we do not expect crazy amounts of stimulus coming through from the government to really get the financial markets going. Policy remains supportive. There's been acknowledgement of risks in the economy, but China does not have the means to stimulate the economy like the US Treasury and the Fed, because the CNY is not the reserve currency, etc., etc. So the economy is heading in the right direction. The Fed rate cut, hopefully coming through tonight, will be positive for Chinese equities and global equities. We expect flows out of the US, and some of that flowing into China over the long term. And right now, valuations, we believe, just very, very attractive in China. And I've got a couple of PS slides after the summary slide showing how attractive the valuations are. These are long-term cyclically adjusted PE ratios. So we can see the light blue and the red line representing India and the US at all-time highs, adjusted for sort of investment cycle, cyclically adjusted, they are at all-time highs, and China at all-time lows. So right now, we believe that's why we believe China is extremely, extremely attractive, especially relative to markets like India and the US. It's priced at a third to a quarter of the valuation ratios of those markets. If we look at in history, if you invested in, these are 12-month forward-looking returns. If you invested at the peaks of historical valuations, I mean, for US and India, we've way surpassed that. So it becomes more and more risky the higher the valuations, etc. This is all equities, by the way. This is it doesn't include any bonds. So right now, we do have diverging valuations in China versus the rest of the market. And the last slide is certainly we are at a bottom of the cycle. And historically, when Chinese markets rally, they do rally very quickly and in quite volatile fashion upwards too. So we are expecting the next rally to be quite strong when it does come through. And with that, I think that's it from me.
Thanks, Tian, for that very, very insightful presentation. I really enjoyed that. We're going to open up for some questions. So if anyone's got a question, then please feel free to either post the question on the chat, or you can raise your hand and we can address the questions. Tian, before I haven't seen any questions on the chat as yet, so I will kick off with my own. I am quite interested in on the economic growth side. I think Chinese economic growth is pretty relevant to South Africa, with China being quite a large commodity user and obviously South Africa being a commodity producer. There's always a lot of interest in economic growth. So my first question is, China has this 5% growth target. Whenever there's disappointments, it's always big in the news. It's quite negative in terms of sentiment for the markets. So the first thing is, does China really need to grow at 5%? And is that 5% achievable? If it is, how do they do it?
So, yeah, to answer the first part of your question, we don't believe it's absolutely necessary to hit an exact number in GDP target, and that's what government officials have come out to say over the past couple of years. So, if we go a decade back in China, it was believed that it was absolutely necessary to hit at least 8% GDP growth to ensure that there's enough new employment demand to try and absorb like the 10, 11 million graduates that come through into the market every year. But over sort of the past 2 decades of experience, we haven't seen an exact direct correlation in that sort of X amount of GDP growth as an overall number, ensuring that Chinese society grows harmoniously, because over the past 2 decades, all the funds have been channeled, a lot of inefficient funding has been channeled into the property sector, which doesn't necessarily generate overall economic benefits. That's why the government a couple of years ago came through to say GDP targets are now around, I think, around or approximately 5%. So we believe that's a number that's been calculated. So our internal Prescient assumption is that without the property slump, Chinese economy can probably grow 6.5-7% per annum. But with the property drag of probably our base case assumption is around 1.5% per annum for the next 5 to 10 years. It takes that down to the sort of 4.5, conservatively 4.5 to 5% range. So we do believe that is very achievable. If we look at, so exports is certainly helping right now for this year. We are seeing the government pushing through policies on the consumption and the services side. So right now, the latest number is 4.6. We do think around 5%. When we say around 5%, a range between 4.5 and 5.5. We believe that's very achievable. And the policy, you don't really need to be very aggressive with policies to try and achieve that. China is still sort of a low income economy, GDP per capita around $12,000, still quite far from sort of the $20,000 OECD sort of minimum benchmark. So we still have a lot of room for growth. I think linking your comment to the South African economy, Chinese demand for commodities, etc., with the slump in the property sector, we are seeing sort of demand for steel, concrete, etc., or sort of not necessarily falling off a cliff, but declining significantly. The good news for South Africa is that throughout the COVID years, I'm not sure if everyone remembers, China actually had a poor relationship with Australia, with their previous administration. I think the Prime Minister's name was Morris at the time. So when China didn't allow imports of, well, not officially, but didn't allow imports of Australian coal, for example, and South Africa was right there ready to replace Australia, only for Transnet to fail us and unable to transport enough supply to the port. So we do believe South Africa stands to benefit from Chinese demand. We do believe there are more structural issues in South Africa, at least from China. This is what we are seeing. If South Africa's internal issues, for example, it's great to see load shedding not being an issue for almost 6 months now. So with a lot of issues sorted out internally in South Africa with BRICS going really strong. We do see South Africa benefiting even from the 5% per annum going forward of Chinese economic growth. So I think that's a strong positive for both, not necessarily China, but for South Africa as a whole.
Thanks for that. I see we've got a question on geopolitics. I'm going to get to that. I just want to tackle the policy direction because you did mention that first. I've seen some market commentators actually calling for aggressive stimulus boost. They say that that would obviously boost the markets a little bit more. But from what you're saying, it sounds like you're saying that the policy direction is more for a sustainable growth. Would that be the right way of reading it in terms of would it be more appropriate to do aggressive stimulus, or is it or is the government looking at something that's totally different?
So I think the policymakers here, I think if we can describe them with one word from our experiences, they are extremely competent. So what they've gone for currently is kind of a mixed approach. So I'll give you a couple of examples. And some of them are probably rumors rather than confirmed. And there's reasons why they are that way. So, for example, one of the rumors we've heard is that the PBOC, the Chinese Central Bank, is lowering interest rates by 10, 20 basis points. But in reality, some of the players in the property sector, in order to survive, they need access to funding at below 1%. So there's no way, for example, for the central bank to all of a sudden lower. Right now, the medium-term funding rate is 2.3%. There's no way for them to cut 130 basis points officially. What we have seen is certain local governments have been using fiscal means to sort of subsidize the interest on loans that some key players in the property sectors are getting, so that their net interest rate that they pay actually gets towards that 1 or even below 1%. So that's one area we've seen it's quite a smart way of doing it selectively. And then your question about sustainable balanced growth, and that's exactly what the policymakers are doing here, is that the sort of key message that's come out is that they do not want to throw good money after bad projects. And what they are trying to say is that they do not want to throw good new money into this bottomless pit of reviving the property bubble, because the property bubble is not going to help the Chinese economy become prosperous at an overall level. It's going to make your GDP number look pretty, but there's still going to be a lot of youth unemployment, for example. There's still going to be tech sort of deficiency issues. So I mentioned tech deficiency is that we've seen a lot of the fiscal funding actually go towards advanced manufacturing. So your semiconductor and your software and all of that is highly publicized, and they're achieving. So in the EV sector, in the car sector, for example, a lot of funding and policies are directed towards productive sectors that will generate new economic sort of rewards for China rather than trying to subsidize. Now, we believe a lot of the market commentators, when they say blanket stimulus, very few people give detailed sort of suggestions of where the blanket fiscal stimulus should go. We've seen a lot of, I mentioned earlier, almost 5.5 trillion CNY since October last year. That's just for the property sector, and that's just stabilized. So for the government really to bail out the property sector, for the stock market to have a temporary rally, when I say temporary, maybe 1, maybe 2, maybe 3 years, a temporary rally for an eventual collapse again, I think that's what the policymakers do not want to do, and they've continued to come out to say that because the financial media outlets continue to call for that type of stimulus, including the IMF. Which is actually quite irresponsible in our view. But yeah, I think that's where the policymakers are heading. It's the right direction. It's not the easiest in the short term, but it's very clear that it's the correct decision or the correct policies for the long term for us.
Okay, thanks for that. I think a China presentation is incomplete without a discussion on geopolitics. Yes. Richard is obviously asking here about the implications of a Trump victory, especially with the threat of tariffs. I think it goes beyond America, but maybe firstly a comment on the impact of the American elections on China, and then we can take it from there. So beyond America, then you can comment on the tariffs. I think Europe has also has similarly put on some tariffs. So maybe a comment on that.
Cool. So in terms of US elections, what we are hearing on the street here, well, that's not necessarily practically on the street, but when we speak to some of the decision makers in China, is that a Trump presidency is preferred. But when I say preferred, is that there are no illusions in Chinese policymaker or Chinese leadership circles that China-US relations will get any better from its current state. So it's almost just managing the floor, or managing the deterioration at an overall level between the two countries. But out of, at least it used to be Biden versus Trump. So Trump was more preferred due to the fact that he appears to be more transactional. He may apply stupid tariffs, crazy tariffs, but there's something clear that he wants, and there's a way to negotiate. Whereas the Biden administration over the past 4 years, it's been very unclear what they want. So, for example, the Biden-Harris administration 4 years ago came into power with the election campaign against trade tariffs. But when they came in, they just doubled down on tariffs and sanctions, etc. So there's a lot of policy uncertainty with the current Democratic administration. It's too early to tell what Kamala Harris's actual policies will be. Rumors are that they will differ somewhat from Joe Biden, but it's just a lot of question marks. So, ever since Joe Biden dropped out, Kamala Harris came in, I think China, along with the rest of the US, has been trying to find out more about what Kamala Harris will do. We also await that. But I think overall, Republican versus Democrat, out of the two evils for China, a Republican presidency wouldn't be too bad. So this is what we're hearing on the street here. In terms of Trump's proposed 60% tariffs on everything from China, we believe it's somewhat unlikely. Probably highly unlikely for a lot of. He may impose 60% tariffs on a lot of things. So what we've seen in terms of election-related tariffs, if we can call it, is Biden slapping 100% tariffs on Chinese EVs. What we've seen recently is weird tariffs on Chinese-made syringes. I think last week we heard, or was it Monday or Friday, we heard new 50% tariffs being applied on Chinese-made syringes. When you have inflation problems and syringes not really being a strategic national interest, it doesn't really make sense to us. But with these are obviously policies we believe trying to show that the Democrats have a tough stance on China. One of the other things we believe why a Republican government may be better for China and US relations is that between the Democrats and the Republicans, by definition, the Republicans are just more anti-China than the Democrats. So the Republicans have to do less to try and prove themselves, whereas we believe that Democrats have really outdone themselves to try and appear to be as anti-China as the Republicans. So this is a lot of sort of election and politics talk, but so word on the street, to summarize, word on the street, a Trump presidency is probably slightly preferred, but we do have a lot of unknowns on Harris. And 60% tariffs on everything, probably unlikely, but we wouldn't be surprised if there will be 60% tariffs applied on a new bunch of Chinese goods that don't get a lot of volume into the US. So, I mean, US inflation is a bit of an issue if all of these tariffs come through again. So, I think it's probably election talk, but who knows if Trump does become president. I don't want to rule anything out for sure from my side.
Yeah. I think in addition to that, you've also seen over the years sanctions on Chinese companies as well. I think ByteDance has been a big one. Recently, you've also had Huawei in the recent past. I'm just curious, what is the there's obviously an impact on these companies coming from sanctions. And Huawei actually was quite interesting for me in the last week because I saw the Apple release the new iPhone, and then they also released their new cell phone, which seemed to be a lot more technologically advanced. And I was wondering, as a sanctioned firm, how they've actually been doing post the sanctions that they've got.
So absolutely, I think Huawei since 2019, when the initial sanctions, we actually covered it slightly in our quarterly commentary. I'm not sure if you've seen the Huawei story, but since 2019, Huawei struggled in terms of their consumer phones division. So it pretty much went outside of China. It pretty much dropped to zero. I think the two biggest areas where Huawei was hit was chips. They couldn't get access to advanced microchips for the flagship range of phones. So they could still build the cheap phones because they weren't limited to, they weren't sanctioned on buying cheaper chips, or they could make themselves, etc. But what our understanding is that the consumer phones division, mobile phones division, was a cash cow for Huawei's R&D efforts. And Huawei's R&D efforts are the eventual sort of target of US sanctions. Unfortunately for the US sort of Commerce Department, those sanctions seem to have just delayed rather than halted sort of Huawei, or in essence China's technological advancements in the sector. And China probably had no ambitions to do that before the sanctions, but they were forced to since 2019. So it's crazy that it's been 5 years since Huawei was initially sanctioned. So Huawei this year started to make their own. Nobody publicly knows how exactly they made it, but Huawei not only started to make their own microchips of at least 7 nanometer and below in terms of size, or 7 nanometer and above in terms of how powerful the processor is. They've pretty much completely out-researched and outgrown the US sanctions. We don't think US sanctions, aside from absolutely competing with the iPhone on the most advanced chips, that Huawei cannot compete. Everything else, we believe the sanctions have been a failure, especially on Huawei. And that probably speaks to the wider sector. So China wasn't just sanctioned in terms of Huawei. China was sanctioned in terms of overall advanced chips, 7 nanometers and below. China was sanctioned on chip manufacturing equipment. So your lithography machines that you need, you have two types. You have your DUV, which is deep ultraviolet, and then you have the most advanced, which is EUV, extreme ultraviolet, that you can make 5 nanometer and below chips. China cannot buy those from ASML, which is the world's leading lithography machine maker. China cannot use any EDA, so sort of chip design software that with any US technology. And so they've really been hit hard. It was a dark few years, probably 2020, 2021, maybe 2022. But we've really seen Huawei, even coming out with chips to compete with NVIDIA in China. So NVIDIA is not allowed to sell its most advanced chips in China. They have to sell discounted in terms of capability versions in China at inflated prices. So Huawei comes out with alternatives and is starting to take market share, not just from Apple in the consumer. Well, by the way, Huawei is back at number 1 in terms of mobile phone market share within China. They still cannot compete outside of China because they don't have access to Android or iOS, which is the two main operating systems. So it's just not convenient for people to use. So overall, if I had to call it at this point in time, we would say the US sanctions have hurt China, continues to hurt China, but China appears to be well on the way of bypassing, or not bypassing, just going right through all of the US's tech sanctions. Unfortunately for the US, unfortunately for China. I think hopefully that answers your question there.
Yeah, that's great. Mike, I see. I think you've got a question. I see your hand is up. If you can unmute yourself and ask the question.
Sure. Thanks. How's it, Tian? You spoke about, I guess, the past experiences when this China sale ends. There's like quite a sharp move up in the market. Have you seen? Is there sort of any catalyst that's been common amongst those? And I guess what I'm trying to get is that. What would you think would be the catalyst at this point in time for us to have a sharp move up in the market?
So we've been trying to look for a consistent catalyst, and we never find one. So every one of these sort of sharp rallies up, it's always something. If we look back at time, it's always something different, and it's always something random. It's not necessarily that the government puts in sanctions. One of the rallies was caused by a government or the regulators just I think reducing stamp duty and overall trading fees, and then there was like a crazy rally for a few months. Small things like that. The regulators have tried these sort of policies again this time. That's why we saw some short rallies, but none of these rallies were long-lived. We think if we look back, I'm sure when it rallies again, it's going to be some other random factor. So, for example, the sort of 2019 to 2021 was actually a COVID-related rally. Who would have thought it was COVID? It was COVID. The world sort of collapsed. China dropped a little bit, and then China contained it in the initial years, and then it just had a crazy rally. But there was not much fundamentals backing up. There was valuation multiples going higher, similar to the S&P and the Nifty currently. And then the market now has just become overly depressed. The valuation earnings are actually flat across A-shares, down about over the past 5 years, on average, earnings down about 10%, but markets down about 40%. So we're having the divergence. Right now, we're just waiting. We believe anything could be the catalyst because the fundamentals are just so stretched that they have to be ripped. And the fundamentals are strong, it's a positive. So everybody talks about China becoming the next Japan. So right now, if we look at Hong Kong, the market index PE is between 6 and 7. So earnings multiple on an entire index between 6 and 7. On Chinese mainland onshore, it's between 10 and 11. At the absolute bottom of the Japanese market bubble collapse. So when the Japanese market bubble collapsed, well, before it continued to decline, at the bottom of 1991, the Japanese equity market PE, as if you look at MSCI data, was anything between 40 and 50. So at the bottom of the Japanese market crash, earnings multiples at an index level was probably between 5 and 8, between 4 and 8 times China currently. So it's really incomparable. You can always find a lot of similarities. The market has been depressed for the last few years, but the economy is growing. I mean, we really don't have a lot of the problems that aside from the property sector, or the rest of the economy is actually quite different to Japan in terms of GDP per capita, in terms of just organic room for growth. I can probably talk a long time just on the differences, but essentially, sorry, back to your question, it's always, every one of these spikes, it's always something random. Obviously, the markets were we do not expect the 616% again. Back in 2006, the market was a lot more concentrated. The size of the market was a lot smaller, so it was much more volatile. The market could be driven up much more quickly. Right now, we don't expect this magnitude of change, but high double, triple-digit growth is certainly within our scope of expectations.
Thanks, Richard. I see you've got your hand up. You can unmute yourself and ask a question if you've got one.
Thanks, Tawanda. So this is a follow-up to Mike's question, and I think for most of us, we realize that China's, well, your markets has suffered mostly from sentiment. And a lot of that came from sort of government policy that came through in the fairly recent part. Can you just comment on what you're seeing on that side in terms of the policy shift that we obviously did start to see a bit of a pickup in policy shift, but I haven't heard anything recently. Can you give us an update there?
Yeah, so you're absolutely right. So back in it started in 2019, sort of anti-monopoly. I'm going to stop sharing my screen here. Back in 2019 was when the first sort of anti-monopoly regulation started coming out in the tech sector. And then 2020, 2021, there was just too much all concentrated together and really spoofed off investors. But the reality is those regulations didn't really affect the fundamental competitiveness of a lot of the tech companies. But that's a side note. And Richard, you mentioned very rightly so that we haven't heard much for quite a long time. So since probably the second half of last year, everything went quiet. So this year, we actually, last month or maybe 2 months ago, we came out to say, the regulator came out to say our investigation on Alibaba and Ant Group, all of these had ended and concluded, and we were happy. So if we go rewind back to end of last year when we saw draft gaming regulations come out late in December, I'm not sure if anyone recalls, where the Hang Seng Tech Index, I think, dropped like 6% in one day because of draft gaming regulation coming out. The guy quietly, the guy that released the draft gaming regulations quietly got sacked 2 days later. That's the Chinese government's way of saying, okay, we know we've done something wrong, we're quietly correcting it. The Chinese, I guess with any government, they don't come out publicly to say, oh, we made a mistake, we're going to correct our course, but they do make the actual changes. So right now, if you speak to regulators verbally, etc., they will say we are open for business, and this is what we've been told. Regulations are not going to be spoken of. It's sort of in a it never happened kind of mode. It's just promoting sort of market organic competition and organic growth. So there's been a huge shift to try and revive confidence in the market. And at some point in future, regulation will come back again to try and sort of ensure the orderly operation of sectors. So to give you some background of why some of the regulations came out is Tencent and Alibaba were buying up every single new startup that came through. It meant like there was no innovation. All the innovation were being bought up and shut down so that Alibaba and Tencent, the two giants, couldn't be challenged. That was what some of the sort of logic coming through behind the regulation. And then if one recall, in 2021, there was a crackdown on after-school education, so your extra lessons and all of that. New Oriental, TAL education, they got hit hard. That was more from a social perspective. If you look at how the kids get drilled, I mean, one of our portfolio managers, Scott, his daughter in primary school, she probably does extra lessons till like 8, 9 p.m. Extra lessons or extramural activities till like 8, 9 p.m. every day. I asked her, I said, how do you do it? And it's just everybody does it here. So that was more from a social perspective to try and ensure people do not have stressed lives. But I think they failed to sort of really account for the market reaction. And we believe through this exercise, they will know how to better approach it next time. We believe regulation will come again at some point in the future, but in the short to medium term, I think the regulators are more trying to revive market confidence than anything else.
Perfect. I think with that, we're going to call it. I'm going to hand over. Thank you very much for that, Tian. I'm going to hand over back to you, Adrian.
Thank you, Tian Pan. And Tian, thank you so much for your time and your insights. Certainly for me, it's been hugely interesting listening to you. And I think we've had some good discussion post your presentation. But thank you for the partnership as well with Seed. We really appreciate it and the insights on an ongoing basis. Guys, and thank you for joining us. We look forward to seeing you again on the 16th of October for our October coffee session. And have an awesome rest of the week. And for those of you going away for the school holidays, travel safe and enjoy the holidays.